Hey everyone, welcome to The Explainer. We are diving straight into a massive shockwave that's literally ripping through global markets right now. We're talking about an event that starts thousands of miles away, but absolutely ends up affecting your investments, the cost of your next flight, and yeah, even the price of painting your living room.
So let me start off by asking you a kind of random question. What do airlines, household paint, and car tires all actually have in common? On the surface, absolutely nothing, right? One flies you across the country, one goes on your walls, and the other hits the pavement. But in the financial markets, they are intimately linked by one invisible, highly volatile thread. Well, the answer is crude oil. It's the ultimate hidden ingredient connecting all these dots. It gets refined into aviation fuel for planes. It's the chemical base for solvents and resins in your household paint, and it provides the carbon black and synthetic rubber used to make tires. When the price of this foundational commodity shakes, these industries earthquake.
Here is our roadmap for today. We're going to cover the geopolitical supply shock, look at crude crossing that crucial $110 mark, examine the squeeze on aviation, see how paint and tire manufacturers are taking a hit, and finally, zoom out to the broader macro fallout. All right, part one, the geopolitical supply shock. You know, every market tremor has an epicenter, and this one really started on March 1st with US and Israeli strikes on Iran. Now, purely looking at the market impact here, the diplomatic and military gridlock over the following weeks essentially blocked the Strait of Hormuz. Why does that matter? Because it's a critical maritime choke point. Roughly a fifth of the world's daily oil consumption flows right through there. With commercial tanker traffic essentially halted, experts are estimating a guaranteed supply loss of around 1 billion barrels. It's just a massive, sudden bottleneck in global energy. Moving to part two, crude oil crosses $110. And that bottleneck leads us right to the trading floors. Brent crude officially breached $110 a barrel. And guys, this isn't just a random number. It represents a historical ceiling where corporate margins traditionally start to break down. When crude trades above $110, it signals severe, cascading inflationary pressure across the globe. We aren't just talking about a mild increase at the gas pump anymore. We're talking about a systemic shock to global manufacturing and transport costs that fundamentally alters how companies price their goods. Now, to put this into perspective, this is a 5-alarm fire for India specifically, 85%. That is the massive amount of crude oil India imports just to meet its domestic requirements. Unlike major oil-producing nations that can kind of offset price spikes with higher export revenues, an 85% dependency means India absorbs the full brunt of this global price shock directly into its economy. There's virtually no domestic buffer to soften the blow here.
Which brings us to part three. Aviation stocks under pressure.
Let's watch the first domino fall. Aviation turbine fuel, or ATF, eats up a massive 30 to 40% of an airline's total operating expenses. It's literally their biggest variable cost. So when crude spikes to $110, ATF prices skyrocket right along with it. Airlines are then trapped, right? They either absorb the cost and destroy their own profit margins, or they pass the cost to passengers by jacking up ticket prices, which threatens to completely kill consumer demand for travel. And believe me, the stock market knows exactly how this trap works. The immediate reaction on Monday was brutal. Interglobe Aviation, the folks who operate IndiGo, dropped a whopping 6.6%, and SpiceJet fell by 5%. Investors are heavily pricing in the fear that these airlines simply won't be able to navigate this sudden margin squeeze without taking severe financial damage in the upcoming quarters. All right, on to part four, paint and tire margin squeezed. This is where we go beyond just fuel costs and look at how oil hides inside everyday manufacturing. Remember that riddle from earlier? Well, paint inputs like solvents, resins, and specialized chemicals are directly linked to crude oil prices. Tires rely heavily on carbon black and synthetic rubber, both of which are petroderivatives. Because these manufacturers can't just pass these sudden costs on consumers overnight without killing demand, they have to absorb the hit initially. Actually, historical data shows that for every 10% increase in crude, paint gross margins take a direct 130 basis point hit. So naturally, the market reacted fast on Monday. JK Tyre plummeted 8.2%. Asian Paints, an absolute heavyweight in the sector, declined by 5%. Apollo Tires fell by 4.9%. These aren't minor hiccups, folks. These are steep sell-offs as Dalal Street rapidly calculates the upcoming hit to corporate profits. Even though demand for new cars or home renovations might stay steady, the underlying cost to produce those goods just shot through the roof. Next up, part five, macro risks, Rupee, and inflation.
Let's zoom out a bit to the bigger macroeconomic picture. We're essentially looking at a vicious cycle here. Since oil is traded in dollars and India imports 85% of its oil, a price spike means India needs drastically more dollars to buy the exact same amount of energy. This higher dollar outflow places massive downward pressure on the Indian currency. We saw the rupee weaken to 94.39 per USD. But here's the catch. A weaker rupee makes buying oil even more expensive, creating this dual threat of currency depreciation and imported inflation, which is basically when the rising cost of foreign goods directly drives up domestic prices.
Actually, there's a quote from economists that hits the nail on the head here. A sustained increase of $10 in crude prices can exacerbate India's current account deficit. We aren't just talking about a temporary dip. If crude sustains itself at this $110 level, the broader consequences, like a widening gap between what India imports and exports, could severely tighten monetary policy. This whole dynamic puts India's highly anticipated double-digit corporate earnings growth at serious risk.
Finally, Part 6, Conclusion.
So, let's tie this all together. We've seen how a geopolitical standoff blocks a strait, takes 1 billion barrels offline, and sends Brent crude soaring past $110. From there, the dominoes fall. Aviation fuel prices crush airline stocks, raw material costs batter paint and tire manufacturers, and the massive dollar demand weakens the rupee, threatening the broader economy. Now, I want to hear from you. Do you think oil prices are going to cool down soon, or will they just keep rising and squeeze the economy even further? Comment below and let me know your predictions. I read as many as I can. If you found this explainer helpful for cutting through the noise and understanding what's actually moving the markets, hit that like button, share it with a friend who's into market analysis, and be sure to subscribe so you never miss out on our deep dives. Thanks so much for hanging out with me today, and I'll see you in the next one.